Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. You asked for it, you got it on this May 1st, 11 a.m. Danny Moses back for Market Call, the host of the On the Tape podcast, who, by the way, will be doing a little prognostication for this weekend's Kentucky Derby. Hello, Danny.
Hello, Guy. Good to see you.
How are you doing today?
I'm doing great, man.
You just saw the Pearl Jam as well, but you saw them on two evenings, if we just want to sort of quickly discuss.
Thursdays and Saturday. Both days I saw. Different band, but I did see them Thursday and Saturday. And even Dan will admit that the set list Saturday blew the Thursday away. So whenever they're in the city, in one city for two nights, you got to go to both because you get a combination. Dan, of course, I'll dox him. He's obviously on his way to Atlanta. It's just, it's like a religious,
Well, let's not get carried away.
Yeah,
what has been a religious experience is the marketplace. And, we've been drawing this trend line, and Amanda, by the way, Amanda's doing great. You can see this long-term uptrend line in the S&P 500 from the 2020 low that we've been drawing for a while. That low that we saw earlier in April was basically, and you can draw it like a boss, we traded right down to it, basically stopped, and we're bounced. Now, here we are, and if you just, so you see the trend line, but if you sort of zoom in a little bit to show the moving averages and where we are, obviously, Danny, the 50-day has crossed the 200-day in a pretty meaningful way, as you can see. That happened, first week, second week of April or thereabouts. We thought correctly that you could see a retracement, a 50% retracement. That got you about 55.50. But here we are now through the 50-day, and a lot of people think we're going to approach the 200-day. I don't want to get too wonky here, but I think the bounce made sense to me. The overshoot maybe is making a little sense to me. The question I have to ask you, and then we have some stats after this, is this thing going to keep going, or is this just a bounce off an oversold condition?
I think it's a bounce off an oversold condition. We'll see if that was actually oversold if we retest those lows or not. Earnings so far, okay. It's the irony here is the big names that have driven the market are, the first earnings we've seen out of those have been pretty decent, with the exception of Tesla, obviously. And so we get two more big ones tonight, but I don't think that's what it's trading on. I actually think, I don't want to jump ahead and come back, but if you look at Fed Fund futures, the irony in all of this was that tariffs cause inflation, right? And the economy was still okay. And so we were looking at some point last week that we had two to three cuts, three at the most towards the end of the year, and nothing in obviously May. We're now almost a certainty in June and 3 to 4 cuts to the end of the year. So if you want to put your bullish hat on, Guy, it's the tariffs get undone and or trade deals happen quickly, which I don't think necessarily occurs, but I'm just putting my bullish hat on, which, doesn't fit on my head all the time.
No, it does not.
And then if you believe the GDP number was, quote, transitory because the amount of inventories that were purchased ahead of time, you can say, okay, well, things appear to be slow, but they're not that bad, but they're slow enough for the Fed to actually cut. And if you get this tariff thing resolved, the Fed will have confidence and inflation expectations will stop dropping, then they can do their thing. And I would also add, Guy, let's not forget, we don't get a dot plot next week with the Fed, but we're going to get an update on QE. And I firmly believe, and he already indicated, that the runoff from the mortgage-backed security portfolio, which is still a couple trillion, will then be used to potentially buy U.S. Treasuries. So we have all that. So a lot going on there, Guy. I think the macro is outweighing the micro, but micro in fits and starts gives people a reason to be optimistic and certain.
Well, you have just in about 45 seconds painted a pretty optimistic outlook. And a lot of things have to happen, obviously. But, you can look at yesterday's report and say, okay, maybe it wasn't as bad as the market initially thought. By the way, as you remember yesterday, the market opened on the lows and wound up closing on the highs. With that said, it was month end, but you have a continuation today. The inflation component of that number to me was concerning, but the bond market didn't really seem to care all that much. So, maybe listen, maybe off a 2-7 hand, maybe you flopped a couple sevens, and maybe you're sitting there with the 3 7s. I don't know. I don't think so, but that's what the market's saying right now. But let's take a look at something, because Lawrence McDonald put this out, and I think this is important. And again, I am not an economist. I want to be crystal clear, but there are a lot of people a lot smarter than I am, and that's a low bar, as I've said a number of times, that think we're either in a or about to go into a recession. Why do I bring that up? Because this is what Larry McDonald's talking about. The current S&P 500 multiple currently, let's just call it 20. Let's just round up a tad. He put this out earlier today. In periods of recessions, we have seen that multiple trade, and I'll read it to you, Danny. 13.4, 12.8, 10.1, 8.9, 6.5, Guess my point is, if in fact we're in one or going into one, the current market multiple basis, versus history does not make a lot of sense. And I've said a number of times, I don't know if we're going to 12 or 13 because of passive investing and a number of other things, but 15 and a half, 16, I don't think that's all that ridiculous in this environment. Thoughts on that?
Let me just clear the air here. I'm not
Clear
optimistic.
Clear
I
it out.
painted
Clear it out, baby.
What would be an optimistic look. All right. So looking at this 19.9, you would say, okay, well, that's justifiable if we've troughed on earnings, right? Or even 23, 24 if you troughed on earnings. Point is that we're just potentially the beginning of a down cycle. How down is that cycle? Is it a recession? I don't really care about the definition of a recession. We all know what it feels like. So I don't need to know next October that, whoa, we had 2 consecutive quarters of negative GDP. I don't care. It's what's happening right now. We know second quarter hasn't started out well from a consumer confidence perspective, right? So we're getting some outlook. I look at the airlines, guys, things like that are real time, and they're not painting a good picture. So I agree with Larry on this. I just don't think the market's trading on valuation at the moment.
I agree with that.
It's just range bound right now. And let's see what kind of earnings revisions we get in a couple weeks for the rest of 2025. I expect it to be slightly lower. And then we can make a decision of the trajectory and apply the correct multiple. So,
I've been concerned. And again, my concern has fallen on deaf ears in terms of what's going on in the market. It doesn't mean the concerns were unjustified. You shouldn't be paying attention to it. But let's just look at the Japanese yen. And people might be saying, why do you have to do this to us? Because I do think it's important. The volatility in dollar yen has been noteworthy in a word. And the move that we saw, this 2 basically handle move to the upside in the dollar, back to strengthen the dollar against the yen. You just don't see moves like this all that often, Danny. And again, it speaks to the volatility in currencies. And if Amanda wants to put up a chart, you'll see where we recently traded down to in dollar yen was the same level we traded down to back in September.
Yeah, listen, Bank of Japan had their meeting last night or this morning, if we want to look at it. No one was expecting them to raise rates. But not only did they not raise rates, they cut their economic forecast. A lot of that's a result of tariffs and uncertainty and a pullback in spending. So here they go again. They're trying to get growth, trying for inflation, remember. And I won't go into the carry trade, so to speak, right now in terms of yen weakness, dollar strength, which appears to be, at least at the moment, coming back slightly. But listen, remains to be seen. But again, a large global economic player that's having issues now as a result of our policies. And so, again, I expect some type of trade deal to happen there, but I just think it's going to take a while to restore the confidence on the global world stage of how the U.S., conducts their policy. So
Jacob is telling me to stop tapping. I'm not tapping. I don't know where the tapping is coming from, but I digress for a second. By the way, Amanda is doing great. So let's move on to some other things here because, single stocks got off the mat. I'll take you quickly to Google because I think not that it's at the epicenter of everything, but there are a lot of moving parts here. And they reported obviously last week. So pull up a Google chart because quite frankly, and this is just me, trading about 161.5. I would have thought, given what we just heard, name like Google off the recent high that we saw back in February should be trading a lot better, but it's not. And I only mention that because a lot of these stocks have bounced like the broader market. To me, the bounces are not that inspiring. So am I just sort of, am I looking for things that aren't there, or am I sort of reading the tea leaves correctly?
No, I think there's some antitrust issues there as it relates to Google specifically that may be a little bit of an overhang on the stock. It's not as sexy. It's more predictable. That being said, it's a name that I like on weakness. I've talked about it before, and they've already reported. So, they're kind of going to trade with the market here a little bit, but I actually like that name on any weakness guy. And I think they're a little bit more exposed to slowdown in advertising spending than some of the other tech companies that are out there. Obviously, they indicated that as much. So it's a little more cyclical than the rest. But again, with that balance sheet, I'm a buyer on dips on that name.
So we have a bunch of questions here around gold. We have one from Roha Buckingham about PHYS, Bill Schmitz about GLD, some couple other people asking. So let's talk about it now. I'll start the ball rolling here. Gold is obviously sold off a little bit. Not a little bit. You probably had what, maybe a 8 or 9% move to the downside, maybe a 10% move ish to the downside in gold, around up. We've seen this before. Number one, I think that sort of flurry to the upside in gold was sort of the Jerome Powell concerns that President Trump was considering maybe terminating him. I think the market got concerned. The bond market clearly did. Now gold is pulled back. You could look at that one formation, that engulfing pattern we had about 5 or 6 trading days ago, and say, you know what, that's sort of bearish. Maybe it gets us down to the 50-day moving average. But I don't think the gold trade, Danny, is over. I don't think you think it's over either.
Not at all. And we keep saying, you see those dips, you go back in periods of time where you almost have the same percentage type dip. They've all been buying opportunities. It's clear gold trades on many different things, as we know. Inflation, deflation, geopolitics, central banks' inability to fund themselves or the need to print money. Right now, it's just an inverse to the S&P pretty much in fear. So it's been used as a fear gauge, pretty much like the VIX. It probably is tracking more than anything. No, I'm a buyer here. I don't think central banks, which are obviously going to have the really hands hodlers, so to speak, are going to be selling anytime soon. I do think something definitely occurred with the shipment of gold from Europe into the US. And I think some dealers were potentially caught short in futures and had to basically make it right. So you might have had that little front running on that. That being said, I'm a buyer here. Both GLD and PHYS certainly track each other. I prefer PHYS because it's closed end and they technically supposedly have the physical there. So I'm a buyer of that on dips versus GLD.
We mentioned, and I should have gotten this slide up, but we can put it up now, and it's from Bloomberg. Bank of Japan will struggle to justify hikes after this. And this just sort of speaks to, I don't know, the hole that they dug themselves or the corner that they painted themselves in. And, you're looking at this and saying, okay, they're starting to pull levers, and they pull lever one way and something bad happens. And then they go the other way to sort of offset that. And then they get something else on the other side. And we're seemingly moving into that here in the United States. So I mention that only because we're going to get a number tomorrow, and that number is going to come in the form of the unemployment rate. Now, let's pull up, by the way, while Elizabeth Young Thomas is on maternity leave, it doesn't mean her and Mario are not doing their work. So let's pull up their first slide, because it all starts to sort of come into something you've been talking about for the last couple of years, the potential for stagflation to catch everybody off guard. And let's look at the first one. GDP growth came in at negative 0.3% in the first quarter, lowest since the first quarter of 2022. But people are saying, you know what, the big import number, it sort of skews things. If you strip everything else, maybe it's not as bad as it looks. But regardless of all that, there's clearly something going on. Now, as you know, imports are great. If you're front loading, that's great. But if there's no demand on the back end, that becomes somewhat problematic. Now, we clearly had an inflation component of that GDP report yesterday, which concerned me. Obviously, the market, not so much. But I bring up the jobs tomorrow, Danny, because this might be the final piece of a potential stagflationary puzzle if, in fact, that unemployment rate starts to move in ways the market is not prepared for.
Yeah, we're clearly in an economic slowdown. This current period is stagflationary without question. The question is it a moment in time, or is it something that lasts quarters, upon quarters? I look at this and I just think that we're going to be in a period of economic slowdown here, trading a certain number, a certain jobs report. I actually think you would want a good number here if you can get it, Guy. So, this is very different. When there's sometimes where companies and consumers act a certain way because of maybe a change in the tax law, and they buy forward, or a certain product that's going to be extinct, and they go buy it before something changes, or Y2K. This is different. We are 100% going to have supply chain issues in the summer. There's no avoiding it at this point, because we've already backed up a few weeks of this, or now maybe several weeks of this. So that's going to happen. And I think that's the thing that caps the market and caps the uncertainty, Guy. What that means to inflation, I don't know, but it's certainly, if you can't buy something that's on the shelf, what you can get's more expensive, and what you can't get is going to hit the economy in terms of a slowdown. So I think we're kind of boxed in here on that. And that's why this is a little bit different when you think about supply chain issues that we did to ourselves versus COVID or something that may have occurred. So,
yeah, I agree with you as well. So let's look at the next slide, because now we're going to try to figure out, like, how does this play? Because if you look, real GDP and interest rates or 10-year yields typically go hand in hand. Now, you're seeing, if you look at the first chart, there's obviously a bit of a divergence going on. So that real GDP number is obviously cratering. We discussed the reasons why, so maybe it gets back. But what are your thoughts here? I want to be crystal clear. I'm still in the camp that I think 10-year yields can go higher. You have brought up a number of times that beware an environment where yields are going lower and the market's going lower, which is something we saw, we saw it, I don't know, late March, early April or so. So we've had something for everybody. I guess my question to you is, how do you think this sort of reconciles itself? What does this mean? 10-year yields almost by definition have to sort of come in, or is it going to be this divergence that continues?
Yields are the elephant in the room. It's the one thing that has to be contained. I think that's the most important thing. Scott Besson has said it much. Earnings come and go. S&P trades come and go, in terms of valuation on the S&P 500. But to your point, the reason that yields go down and the reason that yields goes up are most important. But what's the biggest overhang is we need to fund $8 to $9 trillion of debt need to be issued this year, right? And so that's the biggest issue, the cost of capital. I'll note that the longer end of the yield curve has not come in, like the shorter to mid parts. If you look at the 30-year yield, yes, it's come off the highs, but it's not. So people's willingness to take risk out on the yield curve is certainly obvious, or willingness to not take risk, I should say, is obvious. So a lot here, Guy. This could change on a dime. We could get, on a true economic slowdown, you could see 10-year yields going back under 4% for a moment, and certainly on a good number, and/or this tariff stuff goes on and we alienate buyers of our debt, you can see it go up. But again, I expect quantitative easing language next week, and so I think that's the other thing that's driving it. So,
well, if you get that, maybe that gives you put a bit of a cushion in terms of the market. I don't think you have a valuation cushion, but maybe you have a Fed one. I don't know. But the last bullet point of the 4 here, this is where things get a little interesting. So analysts don't expect an earnings recession this year or next. That's fine. But it's hard for earnings to grow if GDP is not. I think that's sort of the point, right? Like, how are you going to get the earnings growth necessary to, I guess, substantiate or to back up this valuation when GDP is going the wrong way? See, that's one of the things I'm struggling with here. Like, unless Danny, and maybe you feel this way, I don't think you do, unless the market is willing to pay a higher multiple because they think the United States is sort of the best, the best house in maybe a lousy neighborhood.
Yeah, I think that's right. I think sometimes you'll overlook certain things. Obviously, over the long period of time, you can't trade the end of the world, so you want to hope things are going to be okay. So, I think that's accurate, Guy.
Let's look at the 10-year. Amanda made a nice chart here, and this is, to your point, how things can change on a dime. And this is a 10-year yield chart, and a lot of things happening. We've been sort of vacillating either side of the 50-day, 200-day moving average. If you take a look at this chart, I mention it because there's a chance that the 200-day moving average crosses above the 50-day. So, the same way the 50-day crossed through it back in December, and we had that huge spike in yields. Maybe we get a point here where the 200-day starts to slope higher, and then the 50-day starts to reverse and go higher as well, which would sort of back up or substantiate some of the things that I'm thinking. But is it just sort of no man's land here? Am I making too much out of this? Because I guess much ado about nothing. If you go back, you back out that high that we saw in earlier this year, you back out the low that we saw in April, and since November-ish, we're basically 4.25 in the 10-year.
Listen, dollar strength is the other thing that you should obviously look at, and all the stuff that they wanted to happen, which was dollar remain strong, yields to come down. Again, we're getting little pieces of it where the puzzle kind of works and the S&P 500 trades higher. You shouldn't mind higher yields if it comes with good economic growth, because those fit together. That's why I've always said beware of the time, to your point, where yields come down and the market trades down. It's telling you we've had that obviously for periods of time. We had it for a period of time yesterday. We had a period of time last week where the market would trade off. So again, it is a no man's land, Guy, but it's not at a level that is alarming. It's the direction that always matters. So we go from 420 back to 435, 440. Before we get to that 450 or 460 level, that'll be alarming. And why the reasons that that's happening. So I think there's probably a little too much optimism about trade deals getting done, right, in the near term. But again, I want to reiterate one more time. I think people believe that quantitative easing is coming back to the forefront, and that's a technical tool that can come out of the shed here. So I really believe that.
So this is from Ethan Lip, and if Amanda wants to throw this question up, it's about Microsoft. This is actually a pretty interesting question. So I'll read it. So the current earnings being backward looking for Microsoft, any concern with supply chain disruption from Asia? And this is not just about Microsoft, by the way. It's about, if so, how would you game out revenue projections? You talked about this, Danny. I mean, you said this earlier. And again, the 50-day crossed through the 200-day moving average, both still sloping lower. We've seen this huge acceleration, or at least huge move for today. I mean, how do you sort of wrap your head around all this? Like, I guess my question is, what did the market sort of miss here? And is Ethan bringing up a valid concern that, there's going to be some supply chain disruptions, as you mentioned earlier in this show?
They are immune to some of that. Obviously, they did tell you what was happening on the consumer side of their business. They did tell you, what was happening on the enterprise side of their business. I think this is an overreaction to the upside, guy. But again, these are very large market cap companies that fund managers can't afford to not be in when they move like this. So I've always felt on these type of up moves, it's a chase that always occurs on the back of kind of a 5 to 6% run that causes it thing to be self-fulfilling that's going to run. But again, here you have a stable company, no issues, pretty immune from tariffs for the most part, but not all, obviously things like Xbox and so forth. But so it's just a safe place to be. And again, I think people will pay premium versus the growth rate to feel safe in some of these large cap names. And you can get in and out of this thing, millions of shares in minutes. So again, right. Fund managers' ability to express a trade or a view and get longer the market, this is one way to do it. So,
well, it's gotten expensive again right before our eyes. So this question leads us to a couple slides. This is from Matt Walter. Would you rather Apple or Amazon? So before we answer that question, we have some implied earnings moves. So let's take a look at this, because CC, Amanda, Timmy, Jacob, Bill all did a great job. Here's the first one we want to take a look at, and it comes in the form of Apple. The implied move is plus or minus 4%, which doesn't seem like a lot. We obviously traded down to the levels that we broke out from in June of last year when they had their whatever day. I forget what they called it. To me, it's all nonsense. But, they had their technology day or whatever they called it. And the stock, which closed around, 175, 180, was then effectively off to the races. Well, we completely obliterated that move and traded back down. But here we are, Danny, sort of running up into earnings, implied move of 4%. Let's go to the next one, because it's Amazon. Little bigger implied move. Again, a name that basically traded down effectively to levels that we saw last summer. This one looks a tad more, I don't know. It's hard for me to sort of put my finger on it. But again, same type of setup, 50-day cross into 200-day. But we saw that in Microsoft, and you saw what happened. So I'll make you play the game, and then I'll play the game. Would you rather into earnings, Apple or Amazon?
Amazon. By the way, I don't know if Amazon or Apple are even allowed to talk about tariffs, because, they might get yelled at. But Apple certainly is the more consumer facing, the more exposed to Asia in terms of manufacturing. And it's just common sense that they're going to say there's going to be disruptions in production of some kind and/or consumer slowdown, the consumer being pickier about what they're buying and when they're buying it. So to me, Apple would be the one that I would avoid into it. Amazon is a little bit more diverse. They can actually benefit at times from their online business by, replacing some of the Asian names that are on the online business. And so I would rather on Amazon here. AWS, I'm sure, is killing it to a degree. Their live TV is killing it. They're other much more diversified than they were, and they're more tariff immune. So I would choose
I agree with
Amazon.
that. I'll play the game with you as well. I'm with Danny Moses on this one. As much as Apple is, it's just, in terms of a lot of different things, the fact that it's in 415 or 420 ETFs, of which it's one of the top 15 holdings, so they win in the passive investing game. As much as people give them a pass on a number of different things and are willing to pay up for their earnings, to me, regardless of this move lower than the subsequent bounce, it's still expensive. And they're still a consumer-facing company in large part, and I still think they have a China problem that nobody wants to sort of acknowledge. I think Amazon, if I look at the Microsoft quarter and I start to connect some dots, Amazon might have some giddy up here. We've seen it before, and you could see a similar reaction as to what we saw in Microsoft. Oh, sorry about this. We gotta
No, we're good.
Crank out a couple things real quick before we get to the Derby picks. Walmart's been a name that you've talked about. Sold off hard after last earnings release. Probably more than I thought, but it's getting back on the horse. We had Dana Telsey on Fast Money yesterday. Walmart's still a name that she likes. I do as well. You were early on this. Typically, early is wrong. In this case, early was right. What do you make of Walmart here, given the sell-off and then the subsequent bounce?
I think we had the same conversation last week. If anyone can get through this and pass it on to the consumer and put pressure on the suppliers, it's Walmart. They proved that out through COVID. It's very expensive. People are willing to pay that premium right now. Fine. So don't use valuation as a reason to either short it or necessarily sell it, because what other retailer, if you need exposure to the sector, would you potentially rather be in right now? So safety and numbers guy to a degree here. And so again, if we get some type of resolution, but again, I think numbers are going to come down on Walmart guy. I'm not saying that they're not. It may even be more expensive than we realize. I'm not a buyer here, but I would not necessarily sell it if I had it here, if I needed a place to have consumer exposure. So
what day of the week is today?
Today is Thursday.
What day? What day of what is the month that we find ourselves in?
May. It's May Day, and the first Saturday of May. I know where you're going.
First Saturday of May is sometimes it's May 1st, sometimes it's May 2nd. This year it's May 3rd. We did a little graphic for you, so let's pull it up before we sort of Audi 5000. These are the post positions and at least the odds today. This is all subject to change for the 20 horses in the Run for the Roses. Danny Moses, take it away.
As you can see, the one horse Citizen Bull has our colors on it, Starlight Racing. So it's part of a bigger group that owns it, but they're going to run with our colors on the horse. Mike Smith is on the 4-horse Rodriguez, Martin Garcia on the 1. The 4-horse Rodriguez is also a Starlight affiliated horse, so we will be there cheering them on. So obviously like the 1 and 4, regardless of having a part of those horses, I like them. So 1-4 kind of exacted there. D. Wayne Lucas on American Promise, 89-year-old trainer. He's certainly going to be the favorite. Those odds, by the way, the live odds in American Promise are down from 30-1 right now to 13-1. So money's coming in. Luxor Cafe, Japanese horse, I will note, has run 6 times in Japan, never in the U.S. No Japanese horse has ever won the Derby. However, it looks like it's going to rain on Saturday. I believe it ran in the slop in Japan 4 times. Doesn't mean a lot necessarily, but just keep that in mind. Journalism, obviously the favorite, looks to be the best horse, but guy, that horse has only run against 4 other horses in the last 3 races. So we're talking about 19 other horses. So at 3-1, I would never. I think it's currently 4-1. Burnham Square, I kind of like. I like the change of jockey there that they had for the last race that they won. Publishers only getting play the 13 because Arado Ortiz is on it. I think without Arado Ortiz being on it, it would be much higher than that. Stay away from that. Sandman and Sovereignty, I think, are legitimate horses here. So I've been kind of playing guy, in no particular order. The 1 and 4, obviously. The 5, the 8 and the 9, I think you got to throw in there. Mm-hmm. And then the 17 and 18 as well. I kind of want to be there. So do it any way you want. I talked about a superfecta. Your boy Jay Sloan corrected me. He's correct. There is no 10-cent superfecta at the Derby. They want you to do $1. So what I suggested that would cost $84 the other day on my podcast on the tape may cost $840. So probably a little too much to spend. But throw those horses I mentioned into an exacta box or a trifecta box and have fun at 6:57 p.m. on Saturday evening.
One of my favorite days of the year. Always fun. I've never been. Need to go. Danny Moses, thank you for joining us. Catch Danny on the On the Tape podcast. By the way, your guests have been brilliant. You have been brilliant in hosting the On the Tape podcast, and I am fortunate that you joined us here today on this Thursday for Market Call. Thanks, folks. By the way, I'm sitting down with Stuart Sopp in a little while. That will drop tomorrow. As Danny mentioned, Dan is on his way to Atlanta to see Pearl Jam for like 90th time, which I find a little bit odd, but that's me. But we'll see you folks later. Enjoy the rest of the day.
Thank you, Guy.